FDA approving this high-volume Roche test. How many constructive things are happening? What more do you need to hear?
Well, there are a lot of constructive things happening. I think this is all great news for the market. But as we've spoken about before, this is a medical crisis primarily, obviously with financial implications. So what I'm looking at is how much money goes to the medical sector and specifically to our hospitals, because, while I think the financial markets are certainly going to recover and there's great long-term value, I think the critical thing is our emergency wards, our ICUs, and, those type of things. So, in addition to financial stimulus, I think we need help for our medical sectors.
And John, weigh in, if you will, on where we are just from a market perspective as well. The human toll and tragedy and concerns continue. But there's a question now about if you've got cash on the sidelines, when do you get in? How much do you get in? I know you're thinking about this. How are you approaching it?
It's a very difficult time, Carl, because one doesn't want to go around saying if you had raised cash a year ago, you would be in a good spot right now, because they can't. People who did are looking at a tremendous opportunity to buy things at big discounts. But in that case, you only want to buy the things that are going to survive and prosper, which means the very best names with no leverage, with no tight debt covenants, with no immediate refinancings, etc. So I haven't sold a share of anything in a while, and I'm just tickling with buying things. Our biggest enemy right now is our emotions. Our emotions are right now either screaming sell or buy. Neither one of those is good advice. What we want to do is to preserve capital at this point. It's a very difficult time to be an investor. The same things, by the way, go not only in the stock market, but in the bond market and in private equity and in real estate, where the same forces are at play. It's a time for older, cooler heads to calm people down, I think.
Yeah, it would seem that nothing's immune, especially looking at all the volatility we've seen across so many different asset classes just in the past week alone. Kirk, the fact that we do seem to be poised for a more coordinated response from the federal government, whether it is the Fed stepping in with that $1.5 trillion injection into the financial system yesterday, the fact that you do have this fiscal bill, this potential first phase fiscal bill moving through Congress right now, or those comments from the Treasury Secretary on our air earlier this morning, is this enough? Is this the type of response now? Are these the type of policies that are going to do enough to quell investor concerns and potentially stop what could be a recession?
Oh, I think they will. Look, I can't predict that volatility is going to end. I think the volatility will continue. But one thing I've been very pleased about is the Treasury market. I think it's actually very interesting that Treasury yields are holding in and actually have come up, which I see as a good sign. So I think the support for the Treasury market has been terrific. And I think a lot of the measures that are being taken in terms of the fiscal side, and I hope we see more, I think it was great for the market. So I think actually the markets are functioning pretty well here. Certainly we've got a way to go, but so far so good in terms of, if I knew what was going to happen, I think we would all be pleased. And the markets have actually behaved fairly logically, as hard as that may seem.
Yeah, John, I just want to get your take, given the fact that you do have deep insights on China, as we start to see more supply chains come back online. I think just today you had the report that lowest tally of new cases confirmed in 24 hours in China since January 8th. As that country comes back online, what does it do to global industrial activity?
Well, China is definitely now stabilizing. The supply chain issue from that end is actually getting somewhat better. Now we have an issue from our end because you can't push components and parts through shut down factories. And as my colleague said, this is a medical issue, not an economic issue. But I think China at this point, I think the most destructive thing you're seeing is the blame game between Chinese officials and American officials. It's very stupid. It's very destructive. This is a disease. We need to do everything we can to contain it. We need to do everything we can to try and lubricate the economy, too. So, send people $1,000. The Fed should open the gates, et cetera, et cetera. That's not going to solve the problem. In terms of will it stop a recession, I think no. Recession means people are not working. I think people are going to be not working for some time here and in many other places. But that's not the real issue. The issue is, to me, when it crosses the threshold from being a macro problem, spending, supply chain, et cetera, to being a non-price rationing credit crisis. The biggest issue there to keep your eye on is the corporate bond market. There's a huge corporate bond issue in China with dollar-denominated corporate bonds and a banking system that's not really suited to providing working capital to private companies. In the U.S., we're having heavy outflows from the corporate bond funds at the same time as the bulk of corporate bonds have the lowest possible investment grade rating. If they lose one rating, mutual funds will be forced to sell them by prospectus. So that's the issues. So avoiding a 2008, a Lehman Brothers, keeping credit flowing, keeping the banks open, that's really the issue. And right now, that's not going very well.